So it is a great pleasure for me, a great honor on behalf of the School of Management to introduce you Mike Spence. Let me just highlight a couple of points of his life and career. Mike studied some years ago at Princeton and then Oxford and Harvard University, where he got the PhD in economics. Is now actually NYU Stern Professor and SDA Bocconi Professor in Economics. We are very, let's say, proud to have in our faculty Mike with us. Is Senior Fellow at Hoover Institution and Professor Emeritus of Management in the Graduate School of Business at Stanford University, where you, let's say, have been working for many, many years. He was awarded the Nobel Memorial Prize in Economic Science in 2001 and John Bates Clark Medal from American Economics Association in 1981. I have a very long list of prizes and awards. I can't get through all those lines. I would like just to highlight that he's also a member of the American Economic Association and fellow of the American Academy of Arts and Science and Econometric Society. Mike also edited a book on leadership and growth just this year in 2010. So, ladies and gentlemen, Mike Spence.
Thank you, Alberto. I actually had his job for several years at Stanford, and he's very polite when he said many years ago at Princeton. I mean, he could have said 1908. We don't have that much time tonight, so I'm going to spend a little time talking about the book I've been writing. So if you'll forgive me, I've written a book that's about the emerging economies growth, how it occurs, place it in context, and it's about to come out. It'll be published in this country by an outfit named La Terza. And if you never see me again, it's because it was a bomb. I'm trying to beat Gordon Brown's record of 34 copies sold in the first 6 months, but we'll see. It's called, somewhat mysteriously, The Next Convergence, and I'm going to spend the first few minutes telling you why. And then I'll talk a bit about emerging market or country growth and how this very high sustained growth works in the sense of what are the moving parts and the dynamics. Then I'll talk about the crisis, a bit about China, which has now acquired a very crucial position in the global economy and is entering a really difficult, complex set of transitions, which, if they work, will be an enormous positive, and if they fail, it will slow down the growth in the entire set of emerging countries. And then I want to show you at the end a little bit of research that we did on the structure of the American economy. And I apologize, I want to do this, and I'm in process of doing this for all the major economies in the world. It's a study of structure, evolution of structure. But I've only finished the one on America. It seems to be getting a lot of attention. It kind of scares people, and I think it'll surprise you a little bit. So the paper that last bit is based on is available at the Council on Foreign Relations website, and this is what it's called. So if you look at growth in the world, the scholar who did this is the late Angus Maddison. It's the absolute, gold standard in this kind of research. And obviously the data aren't that great, but what you notice is up until the 18th century, the growth in the global economy was essentially negligible. Now, Angus doesn't like putting up graphs like this. He prefers things in logs, so you can see from the slope what the growth rates are. And then what happened here at the end of this century is the British Industrial Revolution started, and it spread to continental Europe in the next century. And we started a process that is an extraordinary growth acceleration that continued through the 20th century. And I wouldn't want to guess what the bar for the 21st century looked like, but it wouldn't fit on this chart unless something goes badly wrong right about now. So the story in the book, to frame it, is that this was the start of a 200-year process in which 15% of the world's population, who live like you and me, in what are now called advanced countries, but which at the time were actually just the same as everybody else, lived in economies where the incomes went up and the wealth increased. The other 85%, nothing happened whatsoever. Population increased a little bit, and there was no growth. In other words, for 200 years, the 15% did this and everybody else did this. And at the end of World War II, this pattern changed, although we couldn't see it at the time. Nobody really saw it. And that is that a very substantial fraction of the remaining 85% slowly, with faltering starts, started on a growth path. So the way I framed this in this attempt to explain all this to interested people in business, government, policy, finance, whatever point of view, is that the end of World War II was actually the start of a century that we're a little more than halfway through. And the characteristic of that century is that we're going to go from 15% who live like us to something in excess of 75%. In the course of that, the global GDP, which is now, I would guess, somewhere between 55 and 60 trillion, depending on dollars, depending on how you measure it, will at least triple and probably more in the next 30 years as we approach the end of this century. And so this sustained high growth that we're going to take a look at in a minute is actually producing sort of a monumental sort of tectonic shift in the global economy with consequences for everybody in terms of sustainability, pressure on natural resources, environmental things, governance questions, and so on. And so the second part of this book is an attempt to understand what impact did the crisis have, and I'll talk briefly about that on the way through, and then what is the world that my kids and their grandchildren are going to live in, and what are the challenges and opportunities set in that context. This is my favorite graph. It comes from a famous paper by Bob Fogel, Nobel laureate, historian, and that is a picture of the population of the world. And what's fun about it, I mean, it's essentially the same message as the one on the previous graph, and you can't see it, but somebody will hand these out after. But it's annotated with pretty much all the major scientific, medical, public health, and other technological breakthroughs that accompanied this. And this started with the British Industrial Revolution. And you can see the pattern is so dramatically different that it isn't very surprising that we're sort of struggling, with managing this, with people adapting to it, and so on. This is sort of the same kind of thing. This is a picture of the measured inequality that is accounted for by differences between countries. If you go back to 1750 and ask how much inequality in the world was there, the answer was not much, unless you way outweigh the 1% who governed and held all the wealth. And almost all of the global income inequality and wealth inequality was accounted for by differences within countries. 10% was inter-country differences. And by the time we got to right around the end of World War II, it had risen to 60%. That's another way of saying that this group took off, the places we live in, and the others didn't. Now, it turns out it was very difficult to see this pattern emerging. In fact, it looked like it was the opposite. So this is, I'm not going to spend a lot of time on it, but this is the differential between various parts of the world in terms of growth rate relative to the advanced countries, as measured by the OECD membership. And it looked like it was going the wrong way. But certain parts of the world were starting to take off. They happen to be the poorest parts of the world. The high performer in the post-war period, it will not surprise you to know, is Asia. And Asia is by far the most populous part of the world. It's 3.8 billion of the 6.6 billion people, well over half. And so that high growth is actually driving global growth increasingly. Speed. So in the British Industrial Revolution, incomes grew, and all the other things that go with it, at about 1 to 1.5%. And that was considered breathtakingly fast, because the standard before that was 0. Then because we could leverage the technology that had been created in the United Kingdom initially, continental Europe and the United States grew at a faster rate, maybe 2 and 2.5%. So that was kind of the high point in terms of growth up until World War II. The successful emerging economies in the post-war period, not a lot of them, but some important ones, have managed to sustain growth in the 7 to 10% range for 25 years or more on average. So this is a completely different world. I mean, none of us, I think most of us in this room have not experienced what it's like to live in an economy growing at 10%. In an economy growing at 10%, income doubles every 7 years. Every 7 years, right? 14 years and you're 4 times the size. And it just feels, it's very, very chaotic. Now, to take the full journey, I mean, this is just math, but and I'll just say a couple words about it. So if you think of, this graph has 2 messages on it. One, even at these high speed growth rates, it takes a long time to go from poor, think of per capita income of $500, when there's still a fair number of countries like that, to $20,000, which is the low end of the sort of OECD range. In order to do that, you have to double a fair number of times. So what this is a picture in blue of how long it takes at various growth rates to accomplish that. So the United Kingdom was, in the 1.5% range, so it's somewhere in here. Yeah, that's about right. A couple of hundred years. We were a little faster. Notice that this is not linear. These folks are up here. And even here, for the Chinas and now Indias of the world, we're talking about half a century or more to get to make this transition. The other interesting thing about this, and it'll be obvious if you think of it in terms of doubling, is that almost all of it, all the time, is spent getting to the middle income level. Think of it as $10,000. If you start at 500, you got to double and double and double and double and double. And then the last doubling, admittedly you're slowing down then because you're becoming like an advanced country, is only one more doubling from the upper end of the middle income range. So almost all the time in these long transitions from desperately poor to advanced country status occurs in the pre-middle income stage. I won't say a lot about this, but when I was chairing a commission on growth and development for 4 years, that was the life of the commission, and then I shut it down. I keep getting asked the question by skeptical people, why growth? Shouldn't we care about something else? And the answer, I think, was growth is not really what people care about. They care about a lot of things like productive employment, being creative, not starving, a lot of things. It just turns out that without growth, it's very hard to accomplish the things that people, care about. You cannot make people wealthy in a country with per capita incomes of $500 by redistributing income. It's arithmetically impossible. And so growth turns out to be A, very hard to pull off, and B, a terribly important enabler of things that, it's not the only enabler, but it's a terribly important enabler of the things that people care about, especially if they're going to sort of get it done on their own and not do it with continuous sort of external support. I love this graph, so I'll just say it briefly. Economists are dreadful forecasters. And this is a pretty good example, although it's not the worst. So we underestimated the growth in Asia and China and India, a little bit less. And we way overestimated the growth in sub-Saharan Africa. If you go back to the 1950s and 60s, when the sort of modern version of the global economy was put together with general agreement on trade and tariffs and then the beginning of the technology that enables all this integration, economists were asked, development economists were asked, where is the good performance going to be and where will it be poor? And they answered, Africa will be the star performer and Asia will be the basket case. Exactly the opposite of what happened. And the reason we said that, that's meant to be a certain amount of humility on my part. So don't believe anything I'm going to say about the future in about a minute. And the reason we said that is we were fascinated with the wealth that was created from natural resources and dramatically underestimated the wealth that's created by human capital, provided it's educated and built over time. That's really what happened. And so Asia, which tends to be rather short of natural resources, with a few exceptions, kind of looked around the world and said, well, what's the only thing we've got here? And the answer was a lot of people, and they went after it. And Africa suffered the natural resource curse in several of its forms, the worst being the distorting effect that it has on governance. And so what happens in a country that is rich in natural resources is the game, the political game. It's not really a game, it's pretty brutal. Turns into sort of getting your hands on the resources. That is, the game is perceived as zero-sum, and the question is, what's my share? Right? In a place that doesn't have natural resources, the game is, how do we make the pie bigger? And that's what growth means. So the Asians set off, in some sense, in a deprived situation on the right course, and other countries sort of got lost along the way. Now we live in this world in which this has been going on for, 40, 50, 60 years, again, with faltering starting points. I mean, to take the two most important examples for the future, China essentially changed direction in 1978 when Deng Xiaoping came to power and said, this is not going to work, and we're going to lose the whole thing, which means in China, the Communist Party will fail. And said, we're going to try another thing called the market economy with socialist overtones, or something like version of that. And that worked. India accelerated more slowly. It's the world's most complex democracy, and basically started to accelerate in the 1980s, survived a crisis with the help of the current prime minister, a great person, who was then finance minister in 1991, and it's been steady progress since then. So India is now in the 7+% growth sort of category as well. And there's different starting points. Japan was the first. Korea and Taiwan were early, accelerants, but they didn't have, the growth rates were similar, but the size, the sheer size is different from what we're experiencing now. This is the G20 membership. So the G20 now, consisting of these folks and probably a few other systemically important countries arriving at some time in the future, accounts for 85% of the world's GDP and 2/3 of the population. And it is now the global forum post-crisis for managing the global economy, setting priorities. And it's struggling to learn how to do that job. I mean, it's not clear how much progress we've made, other than in the crisis itself, where policy coordination was really very good. Now, I'm going to give you just one example of the systemic importance, maybe one more at the end. The McKinsey Global Institute did a study of the investment patterns in the global economy for the period starting after World War II. And what's interesting and the message is very clear. The global investment rate, this is gross investment as a fraction of global GDP, started out high. Post-war recovery, a lot of investment required to rebuild those cities and bridges and stuff in Japan and Germany, to some extent here, so on. Capital deepening of the economy, and then there's nothing wrong with this. It sort of declined. This is the advanced country effect, and it's the right answer. You don't want to keep investing when the rates of return, private and social, fall too much. Meanwhile, for reasons I'll show you in a minute, the developing countries that are starting to grow at these speeds invest at much higher rates. 35% would be a good guess. China's an outlier at sort of 45%. That's almost half of GDP. Only they didn't matter. These weren't big enough to affect this trend. And we're right here, and now they are. And so what's going to happen in the global economy is that what the prediction is right here. This is the crisis effect. So this pattern is now being restored. And it looks like the global investment rate, driven now by the emerging economies, is going to go up. Now, this raises hundreds of questions. For example, will savings go up at the same rate, or will the cost of capital go up? What's going to happen to countries like the United States and Italy when the cost of capital goes up, including the interest rates? with either current or projected debt levels of 100% plus of GDP. See, we lived in a 15 to 20 year period in which costs of capital were remarkably low. The investment rate was declining and the savings rates were huge globally. And that pattern is, according to McKinsey, and I believe their estimates, is about to change. Now, there's a very well-written study on this for those of you who are interested, so you can go look and see if you believe the savings story. It's a blizzard of complexity. Aging causes savings to fall. The rising size of the emerging markets causes it to rise because they save more, et cetera. So we can't do that tonight. How and how fast do advanced countries grow? Well, the modern theory of growth in an advanced country is pretty well developed now in two parts. One, Bob Solow, for which he got the Nobel Prize, and two, the so-called endogenous growth theory of Paul Romer, Philippe Aghion, and others. So we understand two things. We understand that ultimately growth is driven by technological change. That is, changes that cause total factor productivity to increase. The reason for that is that you can't grow indefinitely by investing in conventional assets because the rate of return declines. There's diminishing marginal returns. So eventually, with no technical change, meaning advancement, all growth will grind to a halt in a market economy. And that was the main message of Solow's work. Unfortunately, he didn't say, and we didn't know where this stuff came from. And so the endogenous growth theory says, look, there's real incentives to do that. And this is not the occasion to try to say, but I think I can tell you what it is. Basically, you innovate because it gives you a temporary advantage in the market through cost or product differentiation or both, things that you are all familiar with. And that advantage, if you're lucky, lasts long enough to make it worthwhile. That is, to make the rate of return on investment high enough to do it. And that is essentially the guts of endogenous growth theory. And what it really is a precise statement of what Schumpeter said many years ago, which is the dynamics of an economy in the end are a pattern of creative destruction. As you create something, and then the process goes on and it gets destroyed in favor of the next thing. And that indeed is very important in these developing economies, because with one very important exception, that's what's happening. So what's going on in the developing countries? First, the fundamental reason you can grow at 7 to 10% as opposed to 2 to 2.5, which is what we grow at on a trend basis in the advanced economies, is we create all the technology that enables that growth, and they import it. And it's a lot less expensive to import it, not costless, but a lot less expensive than it is to do it all over again yourself. So that I just want to leave this message. So and it's hard to see because technology transfer is not an easy thing to lay your hands on, but it is the fundamental driving force behind this growth is that they are sufficiently far behind that simply importing via various channels like foreign direct investment and other things, their potential output goes way up. Well, what's the rest of the story? And that's why, by the way, it's called, at least in the world that I live in, catch-up growth. This is catching up in the sort of knowledge and technological underpinnings of their economy. So the Growth Commission, actually they went along with it, said, okay, how many countries have grown at 7% or more for 25 years or more? Is that really possible? And the answer is there's 13 of them, and there soon will be 15 when Vietnam and India have been at it long enough, and there may very well be others in the future. And these are these economies that have grown at that rate. It's a fairly selective club. I mean, there are 180 countries in the world. Probably 120 of them are developing countries, so this is not a long list. These countries are a little bit all over the place in terms of governance structure, timing, size, where they're located. And so any simple, kind of hypothesis about, what this is correlated with or what causes it is probably fairly easily disconfirmed by finding an example on that chart. So one of the late arrivals is China. It didn't actually accelerate in 61, but the acceleration was so rapid that when you take an average, you go kind of back in time. So that's the high growth set. And so now I just spend a few minutes on what are the ingredients in the dynamics that cause this high growth. One of them is macroeconomic stability. The reason is that this process is driven, once you're importing technology, it's driven by investment. And investment gets killed off by risk created by macroeconomic instability. It's really that simple. Much of the starting and stopping associated with developing country growth, the actual patterns that you see, has to do with the inability to maintain macroeconomic stability. And one of the things that's happened is that they've been learning over time, in part from us and in part from their own experience, to do this better. And the best evidence of that, you'll see it in a sec, is that they did better in the crisis, the most recent crisis, than we did. Now, part of that was they didn't hold toxic assets and a bunch of other nonsense that we created in the United States. But part of it was they just got better at this sort of macroeconomic management. So the performance was way different than it was in the major set of currency crises, balance of payments crises in 97, 98, which originated in Asia. So the key ingredients in this, other than the macroeconomic stability, are the following. Think of it this way. Your potential output's going up. You're a country that has been in a kind of low-level equilibrium. And so to drive this growth, you basically have to have very high levels of investment. The normal capital output ratio for a wide range of economies is 2.5, 2.5 capital to $1 of output, and incrementally, approximately the same. And so to drive 7 to 10% growth, you need investment rates in the 25 to 35% range. The other critical component, which was neglected for a long time, and countries struggle to do this, is the public sector investment, meaning things like education and infrastructure, that needs to occur to support this, is in the 5 to 7% range of GDP, we guess. Okay, there's no theory that tells you that's true. It's just we just looked at a lot of cases. And if you get much below that, it looks like you can't sustain it. Why? Because growth is driven by the private sector investment dynamics, the things that most of you do. But there's got to be an environment in which the rates of return are high enough to justify the investments. And in countries that have inadequate infrastructure in cities, inadequate sewage, inadequate industrial facilities, inadequate ports, you have to be building those in parallel with the private sector investment to keep the investment returns up. So that's what's going on. Now, the country that sort of, elevated the standard again on this one was China. And there are idiosyncratic reasons for that. China, because of its history, ended up with a government that essentially owned all the assets. They have a gigantic balance sheet. And they deployed it rather effectively. Most countries struggle to get this. So if you look at countries that fail to generate this kind of growth carefully and ask why, you'll get two answers. The most important answer is the political system fails. That is, it just doesn't work. And it's a political economy argument. It could be the natural resource curse. It could be, something else. But the most common cause of poor performance is a dysfunctional governance structure, which gives rise to all kinds of things that give you predictable results. If you have a dictatorship or a very concentrated, batch of power, and those people are mainly interested in how rich they are, they couldn't care less about growth, and they don't do anything on this list to move you in that direction. And this is quite uncorrelated with the form of governance, right? So, for example, China is clearly a one-party system. The Japan, Korea, and Taiwan were all dominant single parties with the form of the democratic structure, and they all changed when the middle class emerged and forced them to change. So the picture of the governance side is sort of complicated. It is very interesting. We spent a little time in the volume we did for the Growth Commission that Alberto mentioned on leadership and sort of the politics of all this. I guess there's two other key ingredients. This is operating in an environment that's more like business and less like what we think of when we think of policy in the advanced countries. Now, if you get me going on this, then I'll sort of take an aside that's too far from the main subject. But the bottom line is, when you're in an economy like this where the market institutions and the regulatory institutions are all in the process of being created, models that describe an advanced economy that we use to predict the impacts of policy changes don't work. And the successful countries know they don't work, so they kind of listen to it, and then they sort of, approach it a bit skeptically, and they say, well, that might not happen. And then they do the natural, sensible thing. They experiment. They try stuff. Doesn't work. This probably sounds like decision-making in business, right? You almost never have a kind of, near certainty about what the outcome is, so you muck around and you do the best you can analytically, and you get there. That's what developing country policy setting feels like. And it's one of the reasons there's this huge gulf between us and them, because we don't do policy that way for a whole variety of reasons.